In 2022 and 23, the world witnessed a phenomenon unseen in over 7 decades. Central banks collectively purchased more than 2,000 tons of gold. 2,000 tons. To put that into perspective, that's more gold than any official reserves have moved in a 2-year period since 1950, 73 years ago. And the pace hasn't slowed. By the first 3 quarters of 2024, another 789 tons had been added, putting the year on track for over 1,000 tons. We're not talking about ordinary investors chasing the latest trend on YouTube. These are central banks, the stewards of national wealth and economic sovereignty. Institutions with access to intelligence the public will never see. Advisors who have meticulously studied every collapse of every currency in modern history. Analysts monitoring capital flows, trade settlements, debt levels, and geopolitical tensions in real time. When these entities start buying the same asset in unison, it's not diversification. They're preparing for something far greater. And what is that something? A potential collapse of the dollar. The implications are staggering. Think about it. $37 trillion of U.S. debt poised to be erased not by austerity or growth, but through one of the oldest tools in the financial playbook, currency devaluation facilitated by gold revaluation. This is the same strategy Franklin Roosevelt employed in 1933 during the Great Depression, a strategy that quietly reshaped the balance of global wealth. And today, we are watching history unfold, almost in real time. Let's start with the scale, because numbers tell the story better than words alone. According to the World Gold Council, central banks purchased 1,036 tons of gold in 2022, followed by 1,037 tons in 2023, and 789 tons by the third quarter of 2024. By the end of this year, that total is expected to surpass 1,000 tons again. 3 consecutive years of unprecedented accumulation. For context, the previous record, set in 2018, was a mere 656 tons. We are truly in uncharted territory. And it's not just the volume, it's who is buying. The People's Bank of China, for instance, added 62 tons in November 2023 alone. For 18 consecutive months leading up to May 2024, China reported steady increases in its reserves. Then the report stopped, not because the purchases ceased, but because secrecy became strategic. Analysts now estimate China's true acquisition over 2 years ranges between 1,000 and 2,000 tons, once we include state-owned enterprises, sovereign wealth funds, and other non-reporting vehicles. Why? Because China sees the geopolitical writing on the wall. The U.S. dollar, the backbone of global trade for decades, is increasingly vulnerable. Whoever controls the largest gold reserves when the dollar falters will wield enormous leverage in the new financial order. Russia tells another critical story. The Central Bank of Russia purchased 330 tons in 2022 alone, becoming the world's largest single-year buyer. Despite, or perhaps because of, the severest economic sanctions in modern history, Russia continued accumulating gold through 2023 and 2024. Consider this. In 2022, $300 billion of Russian assets were frozen by Western authorities overnight, a stark warning to every nation holding dollar-denominated assets. If your political decisions clash with U.S. interests, your assets are at risk. The lesson was clear. Hold something untouchable. Gold, stored physically in Moscow, Beijing, or New Delhi, cannot be frozen, seized, or sanctioned. Today, Russia holds 2,333 tons of gold, roughly 25% of its reserves, the highest proportion of any major economy. For comparison, the United States holds 23% of its reserves in gold at official valuations. This isn't coincidence, it's strategic positioning. Russia, shaped by the collapse of the Soviet Union and the 1991 ruble crisis, understands the fragility of fiat currencies better than most. Gold, for them, isn't speculation, it's survival insurance. India provides a cultural dimension to this strategy. The Reserve Bank of India added steadily to its reserves, 33 tons in 2022, 41 tons in 2023, quarter after quarter. India now officially holds 841 tons, but that's just the tip of the iceberg. Indian households privately hold an estimated 25,000 to 30,000 tons, more than any other country's official reserves. Why? A history of currency devaluation has taught generations that gold survives when paper money fails. This is a collective memory encoded into policy and culture alike. Smaller nations are acting with equal resolve. Poland increased its gold reserves by 57% in just 2 years, purchasing 130 tons between 2022 and 23. Its central bank governor openly stated that gold is the ultimate safe asset, a rare admission that a nation is actively preparing for systemic monetary instability. Turkey, facing its own currency crisis and inflation exceeding 85% in 2022, added 160 tons in a single year, while Singapore quietly accumulated large amounts, demonstrating that even the most financially sophisticated nations see signals invisible to the public eye. What connects these moves? Every central bank is anticipating the end of dollar dominance. They know the current system is fragile, and they are preparing for a transition, an era where gold will be the ultimate universal asset. Because in a world of shifting currencies, unstable alliances, and geopolitical weaponization of money, gold remains neutral. Universally recognized, unseizable, and historically reliable, it's the cornerstone of survival in an uncertain financial world. The underlying theme is clear. The dollar, once unassailable, is increasingly weaponized. For decades, the United States leveraged its currency to enforce compliance, freezing assets and cutting off access to dollar clearing for nations that defied its policies. This worked when no alternatives existed. Today, nations are building their own systems, with gold at the foundation. The BRICS nations, Brazil, Russia, India, China, South Africa, have been quietly developing a gold-backed currency since 2022. They now represent 4% of the world's population and 25% of global GDP. In 2023, BRICS expanded, inviting 6 additional nations: Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and the UAE. Some joined immediately, others are deliberating. The expansion signals a deliberate construction of a parallel financial system, one that bypasses the dollar entirely and cannot be frozen by U.S. authorities. This is not speculation, it's official policy. And it demonstrates a profound shift in global financial architecture. Nations are now hedging against the instability of dollar hegemony, and gold is the foundation of this strategy. By now, the pattern is unmistakable. Every major central bank, from Beijing to Moscow, New Delhi to Warsaw, Singapore to Ankara, is quietly, relentlessly accumulating gold. And they are doing so not because they are chasing short-term gains, but because they are preparing for a seismic transformation in the global financial architecture. Take Russia, for instance. In 2022 alone, the Central Bank of Russia purchased 330 tons of gold, making it the largest single-country buyer that year. This was at the height of unprecedented sanctions, $300 billion in frozen dollar assets staring Russia in the face. Overnight, assets once thought untouchable vanished. The lesson was clear. Sovereigns cannot rely on a foreign currency controlled by another superpower. Gold, impervious to sanctions, becomes the ultimate shield. Russia now holds 2,333 tons of gold, 25% of its reserves, the highest ratio of any major economy. For comparison, the United States holds around 23%. This is no accident. This is strategy born from experience: the collapse of the ruble in 1991, the Soviet Union's disintegration, and the bitter lessons of Western financial warfare. China presents an even more complex picture. The People's Bank of China officially reported 62 tons purchased in November 2023, and for 18 months prior, consistently disclosed additions. Analysts believe the real accumulation, accounting for state-owned enterprises and sovereign wealth funds, is somewhere between 1,000 and 2,000 tons since 2022. The underlying message is clear. China is hedging against the inevitable decline of the dollar. Its gold is more than a hedge. It is insurance, a tool to secure sovereignty in a world where dollars can be frozen at a moment's notice. India, too, tells a story of cultural and historical foresight. With 841 tons in official reserves, the Reserve Bank of India buys steadily, quarter by quarter. But Indian households hold an astonishing 25,000 to 30,000 tons privately, more gold than the United States government, more than every Western central bank combined. For India, gold is woven into the cultural consciousness, a store of wealth that survives currency collapses, devaluation, and hyperinflation. It's not merely investment, it's generational wisdom applied in real time. Meanwhile, smaller nations are sending a similar signal. The National Bank of Poland, for instance, increased its reserves by 57% between 2021 and 2020. The governor publicly stated, "Gold is the ultimate safe asset," implicitly admitting Poland is preparing for systemic instability. Turkey, battered by years of currency crises and double-digit inflation, added 160 tons in 2023. Singapore, with its meticulous, almost surgical financial management, quietly grows its reserves. These actions collectively reveal a global consensus. The era of dollar dominance is ending, and gold is the universal hedge. What ties all these purchases together is not randomness, but a shared understanding of an approaching monetary upheaval. The end of the U.S. dollar's monopoly, the collapse of the existing financial order, and the rise of an alternative system, possibly a BRICS-backed gold currency, are on the horizon. Each central bank is preparing for a future that is not yet fully visible but can be inferred through patterns, historical precedent, and geopolitical intelligence. Let's talk about BRICS. Since 2022, Brazil, Russia, India, China, and South Africa have been quietly designing a gold-backed currency. By August 2023, the bloc expanded, inviting 6 new members: Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and the UAE. This expansion is not symbolic, it is strategic. It signals the formation of a parallel financial system, one that does not rely on US dollars, cannot be blocked by Western sanctions, and is anchored in gold. When countries settle trade in a BRICS currency backed by gold, they circumvent the dollar entirely. This is the systemic shock central banks are anticipating. The death of the petrodollar is underway. Since 1974, the U.S. maintained global dominance via the petrodollar, oil priced exclusively in dollars, with military protection in return. This created insatiable global demand for dollars, allowing the U.S. to print money with minimal inflationary consequences. But cracks are appearing. In March 2023, Saudi Arabia sold oil to China in yuan. Russia and India settle in rubles and rupees. China and Brazil transact in yuan and reais. Each agreement erodes dollar dominance, triggering a domino effect that makes dollar collapse inevitable if the trend accelerates. Here's where it becomes more sophisticated: the mechanism of debt reduction through gold revaluation. The U.S. debt stands at $37 trillion, roughly 132% of GDP, with annual interest obligations exceeding $1.2 trillion. Traditional remedies, taxation, spending cuts, or economic growth, cannot solve this. The only viable path is currency devaluation, but executed subtly. Enter gold revaluation, a playbook first used by FDR in 1933. The U.S. holds 8,030 tons of gold, valued at $42 per ounce on the books, despite the market price being $2,700. This discrepancy creates a lever. By revaluing gold on the books to $20,000 per ounce, the effective backing of M2 money supply jumps from 3.4% to 25%. This gives the illusion of sound money while simultaneously devaluing the dollar relative to gold by 87%. The outcome, $37 trillion in debt, becomes, effectively, $4.8 trillion, a stealth transfer of wealth executed via inflation masked as gold revaluation. Creditors, savers, and bondholders lose. The government regains fiscal breathing room. History repeats. In 1933, Americans surrendered their gold at $20.67 per ounce. By January 1934, revaluation to $35 obliterated 40% of private purchasing power while reducing national debt burdens. Central banks are now preparing for a similar event, scaled to the modern globalized economy with far higher stakes. The intelligence central banks possess is staggering. Capital flows in real time, tracking foreign investment shifts away from dollar assets. The IMF notes the dollar's share of global reserves dropping from 61% in 2020 to 58% in 2024, a subtle yet massive outflow. Geopolitical foresight, military timelines, potential conflicts, and asset freeze scenarios are known before they unfold. The precedent set by Russia in 2022 teaches every sovereign that dollars in U.S.-controlled accounts are at risk. Superior economic data. Central banks track inflation more comprehensively than public CPI figures, monitoring wholesale prices, money supply growth, and asset flows to anticipate real purchasing power erosion. Gold, in this context, is not speculation. It is survival. It has preserved wealth across millennia. Weimar Germany, Argentina in the 1980s, Zimbabwe in the 2000s. When currencies fail, gold survives. We are now entering phase one of the global monetary shift. Accumulation, lasting from 2024 to mid-2025. Central banks are quietly amassing gold without triggering price spikes, using direct purchases, intermediaries, and futures contracts. Over $86 billion is being spent annually to buy physical metal while simultaneously divesting dollar-denominated assets. Phase 2, preparation for the reset. Expected late 2025 to 2026. Here, central banks begin strategic coordination, aligning gold holdings, currency swaps, and bilateral agreements to stabilize the coming transition. The goal is not to crash the system overnight, but to orchestrate a controlled shift away from the dollar while minimizing social panic. Key elements of this phase include bilateral and multilateral agreements. Nations will start settling trade in alternative currencies, often backed by gold. For example, China, Russia, and India are already negotiating trade settlements in a hybrid gold-backed BRICS currency. This creates parallel liquidity without immediate disruption. Gradual dollar devaluation. The U.S. will likely permit a controlled decline in the dollar's purchasing power to make gold-backed reserves more attractive globally. Central banks can accumulate gold cheaply now, anticipating massive leverage later. Asset redistribution. Sovereigns may quietly convert a portion of U.S. treasuries, euro-denominated debt, or other fiat reserves into gold or alternative currencies. This subtly reduces exposure to a single currency while signaling a new financial hierarchy. Phase 3, the monetary reset, anticipated 2026 to 2027. This is when the system realigns, with gold-backed currencies assuming a larger role and the dollar losing its monopoly. Expect several markers. Official revaluation of gold reserves. Central banks may announce book values that approach market reality. For the U.S., this could mean adjusting gold reserves to $10,000, $20,000 per ounce, radically improving balance sheets overnight. Introduction of a new global settlement currency, likely BRICS-backed or gold-linked, facilitating international trade outside dollar dominance. Controlled inflation and debt restructuring. Instead of abrupt defaults, governments could use inflationary mechanisms to reduce real debt burdens while preserving market confidence. Why this matters to investors and citizens. Gold is king. Physical gold, ETFs, and gold-backed instruments are not speculative. They are insurance. Those without exposure risk being devalued in the coming reset. Dollar assets may lose purchasing power. Bonds, savings accounts, and cash denominated in fiat currencies face erosion if a gold-backed revaluation occurs. Opportunities in new financial instruments. Countries and private institutions will issue bonds, currency swaps, and structured products linked to gold reserves, potentially yielding massive returns for early adopters. The lesson from history is blunt. Governments always preserve themselves first. Central banks accumulate gold quietly, prepare for controlled resets, and align geopolitical and financial levers. Ordinary citizens, unless aware and prepared, are left holding assets that are legally and financially subordinate to these maneuvers. The takeaway: we are not witnessing random market volatility or speculative trading. We are observing a meticulously orchestrated global preparation for a monetary reset anchored in gold. Those who understand this pattern can position themselves ahead of the curve, while the unprepared will face currency devaluation, wealth erosion, and a dramatic shift in global financial power. The mechanism of dollar collapse and gold revaluation. To understand the scale of what is unfolding, we need to break down the mechanics of the anticipated reset. The U.S. currently carries roughly $37 trillion in debt, with a debt-to-GDP ratio of 132%. Interest payments alone exceed $1.2 trillion annually, more than the defense budget. Simply put, the U.S. cannot repay this debt through taxation, spending cuts, or growth alone. Historically, the solution has always been currency devaluation. But modern execution requires subtlety to avoid public panic. Here's how the playbook works. The official gold revaluation. The U.S. government holds 8,133 tons of gold, valued at statutory book prices far below market reality. On paper, it's about $11 billion. In market terms, it's over $75 billion. By revaluing gold on the balance sheet to $20,000 per ounce, the government can artificially increase reserves to $5.2 trillion, covering 25% of M2 money supply. Illusion of strength. By presenting the dollar as gold-backed, the U.S. can project financial stability, convincing markets and citizens that sound money has returned. The public perceives discipline, while the real effect is massive devaluation. Debt erosion. Once the revaluation occurs, the dollar loses roughly 87% of its purchasing power relative to gold. That means $37 trillion of debt effectively shrinks to $4.8 trillion in real terms. The government has not repaid debt, it has erased it by leveraging monetary instruments. Wealth transfer. Those who hold gold or alternative currency reserves benefit enormously. Countries like China and Russia, which accumulated massive gold reserves quietly, see their assets multiply 8 to 10x. Meanwhile, dollar holders, retirees, and bond investors absorb the loss in real wealth. Historical precedent. Roosevelt, 1933. This is not hypothetical. During the Great Depression, the U.S. faced a 40% debt-to-GDP ratio, soaring unemployment, and collapsing banks. Roosevelt used gold revaluation to reduce the real burden of debt. Executive Order 6-102 forced citizens to surrender gold at $20.67 per ounce. In 1934, gold was revalued to $2 per ounce, a 68% increase overnight. The government effectively created $2.8 billion in new value, reducing real debt burdens and inflating away the crisis. The lesson is clear. Governments can, and historically do, manipulate currency and gold reserves to protect the state and reduce debt, often at the expense of citizens' savings. The same strategy is poised to be deployed again, on a scale 10x larger and faster than 1933. 3 levels of intelligence central banks possess. Central banks act not out of speculation, but because they see what others cannot. Capital flow intelligence. They monitor real-time global investment flows. For instance, the dollar's share of global reserves has dropped from 61% in 2020 to 58% in 2024, representing hundreds of billions exiting dollar-denominated assets. Classified geopolitical intelligence. Banks like the People's Bank of China and the Bank of Russia access classified data on military movements, sanctions risk, and potential conflicts, enabling proactive financial positioning. Advanced economic data. Unlike public CPI numbers, central banks track true inflation across commodities, assets, and currency circulation. With M2 money supply growing 40% in just 2 years, they know inflation is inevitable, far higher than official reports indicate. Why gold is the ultimate asset? Gold is not bought for price speculation. It's a sovereignty hedge. No counterparty risk. Unlike treasuries, stocks, or real estate, gold's value doesn't depend on third parties. Universally accepted, gold transcends borders, sanctions, and political disputes. Cyber impervious. In an age of digital vulnerability, physical gold cannot be hacked or frozen. Inflation preservation, gold has maintained purchasing power across 5,000 years, surviving every currency collapse. Countries holding gold are insulating themselves from geopolitical leverage, currency weaponization, and systemic inflation. The timeline of accumulation and crisis. Phase 1, 2024, mid-2025. Final accumulation. Central banks quietly amass gold using intermediaries and direct purchases. U.S. Treasuries are sold as gold purchases rise. Phase 2, mid-2025-2026. Announcement and adoption. BRICS countries formally deploy a gold-backed currency, enabling initial trade settlements outside dollars. Phase 3, 2027 to 2028. Crisis and revaluation. The U.S. implements gold revaluation, erasing debt, devaluing the dollar, and transferring wealth to gold holders. How ordinary citizens get hit and how to protect yourself. Most people will experience this reset indirectly, often without realizing it at first. Here's the typical chain reaction. Currency devaluation. Cash savings, 401ks, and bonds lose purchasing power. Even if your nominal balances remain, the real value can drop 50–90%. Price inflation. Commodities, food, and energy spike. As the dollar loses credibility internationally, retail prices rise before wages adjust. Asset repricing. Real estate, stocks, and collectibles see massive adjustments. Some sectors may boom, commodities, precious metals, while others crash. Social strain. Governments may attempt price controls, subsidies, or rationing. Banking restrictions or digital currency limits may temporarily restrict access to funds. The survival strategy: gold, crypto, and tangibles. Gold and silver. Physical metal held outside the banking system is the most reliable hedge. Consider allocated bullion or private storage. Cryptocurrencies. Bitcoin and select stablecoins can preserve wealth digitally if banks impose withdrawal limits, though volatility is high. Tangible assets. Food, energy reserves, tools, and even farmland gain value when currency stability collapses. Lessons from history. Germany, 1923. Hyperinflation wiped out middle-class savings in months. Gold and foreign currency preserved purchasing power. Argentina, 2001. Fixed peso-to-dollar system collapsed. Citizens with dollar accounts maintained wealth. Zimbabwe, 2008. Physical goods, livestock, and foreign currencies were the only reliable stores of value. Final takeaways. Timing is everything. We are in a narrow window of preparation. Those who accumulate gold, silver, and tangible assets now stand to preserve and even multiply wealth when the reset hits. Those relying solely on bank accounts, bonds, or unhedged retirement plans will see the largest wealth erosion in decades. Early adopters of physical gold and strategic reserves experience wealth preservation and leverage. Late adopters face scarcity, rapidly rising prices, and financial loss. The hidden opportunity. While this scenario may seem ominous, it's also a once-in-a-generation chance to restructure finances. Convert a portion of fiat savings into hard assets. Diversify globally. Hold some foreign currencies, gold, and digital assets. Focus on skills, barterable goods, and community networks, the invisible wealth that survives currency collapse. Closing thought. History doesn't repeat exactly, but it rhymes with precision. Governments have always found ways to reduce debt without outright default. Gold and tangible assets are the safeguard against systemic collapse, and the coming years may redefine the meaning of money itself.